Hello and good evening, everybody. Welcome to this evening's edition of Women and Money Montreal. My name is Lynn Sock. For those of you who are attending for the first time, I just wanted to give you a little bit of background of who I am and what Women and Money Montreal is. My background, I'm an independent financial security advisor as well as a mortgage broker. I started in finance in 2003. Women and Money Montreal was created in 2020, about 4 years ago. And the goal was to create an environment, a non-judgmental, safe environment for women to learn more about money. So I've been offering these financial literacy sessions weekly. Tonight's actually our 118th. And every week we meet to discuss a different topic related to personal finance, investing, real estate, or entrepreneurship. We've actually moved the entrepreneurship topics to Friday mornings, where I host the Breakfast Club for Women Entrepreneurs. Also online, again, talking about discussing different topics related to entrepreneurship. So welcome everybody. Hopefully the feed is good and everybody sees me. If anybody has any comments or questions as I'm talking about the topic of the week, please feel free to put the comments in the chat and I'll get to them. Feel free to ask as we go along, just in case I go too fast. Tonight is going to be part 2 of a series that I'm doing. 2 weeks ago, we met for investing basics. I thought I was able to cram in all the information into one session. Turns out I can't. So I've divided it up into 4 sessions. And that way I could go into a little bit more detail on each topic. So 2 weeks ago, when we met, we focused on most common account types. And tonight we're going to go into most common investment vehicles. So for those of you who missed out on our session 2 weeks ago, I'm going to do a little bit of a recap. And if you weren't able to attend and want to view the recording, just reach out to me and let me know. You can shoot me an email and I'll send you a copy of the recording. There's a question in the chat. If we subscribe to these webinars without having to do it every week, unfortunately, there isn't a way that we could just sign up once and for you to use the same link. I know that with StreamYard, the webinar feature is still fairly new, so hopefully in the future, it's not necessary to register every week. Trying to experiment with different ways to make it as easy as possible for everybody. So we're going to get into tonight's topic, like I said, which is most common investment vehicles. Just to recap from 2 weeks ago, when it comes to investing, I just wanted to go over just the very, very basics of investments. Now, if you're attending for the first time, I just want to let you know that if you're investment savvy or a little bit more advanced when it comes to investing, these sessions probably aren't for you, at least for the next few weeks. It's very beginner, and it doesn't matter how much savings you have. It doesn't matter how much you make. This could apply to anybody. It's really the basics and how to get started with investing, no matter how much you earn or how much money you have aside. So when we started off, I went over the different account types, and it's important to remember that there's a difference between accounts and investments. So there's an expression that everybody should save for a rainy day and to put money aside and pay yourself first. We've all heard variations of this. So the act of saving is literally taking money and putting it aside, and that's your savings. Once you decide that you're going to put money away, you need to put it in some type of account. So when we met 2 weeks ago, we went over some of the different account types that people use here in Canada to save and invest their money. The most common types of accounts to invest your money are tax-free savings account, registered retirement savings plans, or RRSPs. There's registered education savings plans, RESPs, if you have children. There are also non-registered accounts if you own a corporation or if you've maximized the other types of registered accounts. So think of all these accounts as envelopes that hold your savings. And once you put your savings inside whichever envelope you decide is the best envelope for you to start growing your money, once the money's inside these envelopes, that's when you decide how you want to invest your money. And there are many, many different types of investments with varying degrees of risk. And tonight I'm going to go over the most common types of investment vehicles. It's going to be impossible for me to go over all of them because there are literally thousands of different kinds, but I've broken them down into a few different categories. And I'm going to try to go through them based on level of risk. Okay, so remember, you're putting money aside, you're putting money into an envelope or a type of account. Once the money's in that envelope, now how do we grow our money? How do we invest it? The goal of investing is to make a profit or make a return, but it's also related to how much risk we're willing to take and the time horizon. Your time horizon is how long you have until you need to start pulling out the money. When it comes to risk, there's also a level of financial literacy that goes to that, which is why I personally spend a lot of time educating and showing clients how investments work, because many of the clients that I have come to me and they tell me I don't like taking risk, I don't want to lose any money. But a lot of that stems from lack of education and fear. And also sometimes the people around us aren't necessarily the best. They always tell you about the bad experiences, but they don't tell you about the good experiences. So if we get into the most common types of investments, I'm going to start off with one of my least favorites, guaranteed investment certificates, also known as GICs. GICs are basically a type of investment where the issuer, so typically a bank or a financial institution, will guarantee you a rate of return on your investment for a specific period of time. You could get GICs in shorter terms, so 6 months to a year, and they go, I think the most you could get is up to 5 years. So basically, if I have a lump sum of money and I want to secure it, I don't want to take any risk, and I know I don't need it before a certain period of time, I may choose a GIC as an investment because I want that guarantee. Now, one of the pros of a GIC is that you're guaranteed the return. So for example, let's pretend you received a lump sum of money, an inheritance, a bonus, whatever it is, and you don't want to risk it because you've never received this type of money before, but you don't need it for another year. You might choose to invest that lump sum of money in a 1-year GIC because I don't need it before another year. And at the end of the year, you're guaranteed whatever return it is that was guaranteed to you when it was issued. The cons is that if they're non-cashable GICs, a lot of times you don't have access to that money before the end of the term, and they're rather restrictive. Also, if you are investing in a GIC within an envelope that's a non-registered account, so not a TFSA, not an RRSP, not an RESP, the return or the interest, whatever it is 100% taxable versus other types of capital gains. So that's one of the cons. The other con is that generally speaking, GIC rates are not that high. So in my entire career, I started working in finance in 2003. To be honest, I had never, ever done a GIC before the end of 2022. So around September, October. GIC rates, the rate that is offered, is directly related to interest rates. It's directly related to that famous, rates are going up and down conversation. So here in Canada, it's the Bank of Canada that 8 times a year, they will make a rate announcement. And whether their rate goes up or down, it directly affects GIC rates. So a couple of years ago, in 2022, as many of us have heard, interest rates went up. And when that rate went up, when Bank of Canada's rate went up, so did GIC rates. So they were more attractive. And in 2022, whether I liked it or not as an advisor, again, I like to do a lot of education. I had no choice, but if clients wanted a GIC, I would have to give in and follow through with the transaction. So back in 2022, we saw GIC rates as high as, I think the highest it went was maybe 5.5, 6, I can't remember, percent for 1-2 year terms. Now, since then, especially this year, interest rates have gone down. And because interest rates have gone down, so have GIC rates. So GIC rates now, if you look around, I think they're around the 3.5%, 4%. I don't even think they're at the 4% anymore, but they're less attractive. So generally speaking, over time, if you're talking about a long-term investment, GICs are not a good option because the rates are low. If you want your money to work for you, it's not going to work as a long-term investment. But I know that the fear of losing money makes it attractive for investors, and that's why I spend a lot of time. Educating clients. We have a comment in the chat. Someone asked their bank last week if they offered anything for opening a new RRSP, and they did. So they have an RRSP in the bank. It will add a bonus of $150. It's not much, but wouldn't even ask for it. So thank you for sharing that. Awesome. So GICs, once again, the rate is guaranteed for a specific period of time. As a long-term investment, not the best option because you're missing out on anything that you could ever achieve in the markets, which we'll get into later as another type of investment vehicle. They were attractive a couple of years ago because interest rates were high. When interest rates are high, so are GIC rates. When rates come back down, so do GIC rates. And in the long term, you're not getting the greatest of returns. And if anybody in this room who's watching this webinar tonight has any active GICs, when your GIC is up for renewal, you're not getting the market value. You're not getting the market renewal rate. You're not getting the market rate. So as an example, like I said, right now, GIC rates for 1 year are about 3.5%. If you have a GIC that's up for renewal around now, even though the rate is about 3.5%, your GIC is going to renew at a much lower rate. And if you don't advise your issuer, so your bank or your financial institution, that you don't want it to automatically renew, it will automatically renew at that lower rate. So just be careful with GICs. Not the best option for long-term investing. Next are another one of my favorites, and I'm saying that sarcastically, high interest savings accounts. High interest savings accounts, a little like GICs, except there isn't that guarantee. High interest savings accounts, usually people get pulled in by them because there's some type of promotional rate. I know Tangerine is often promoting promotional rates. You need to be very careful with high interest savings accounts. They're not a good option for long-term investments. They're fine for short-term goals where you need to park your money for a short period of time. Same idea as GICs. Their rates go up and down based on the Bank of Canada's rate announcements. So when rates go up, so do high interest savings accounts rates. When rates go down, so do HISA accounts. High interest savings accounts are also referred to as high yield savings accounts or daily interest savings accounts. Just be careful because the message might be a little bit misconstrued. You might see an advertisement, for example, of a daily interest, high interest savings account at 6%, as an example. So in your head, it's logical and normal for you to think that it's a daily interest savings account. So your daily interest that you're going to earn is 6% a day. No, that doesn't exist, because if that did exist, all of us, I'd be the first person to sign up for that. The rates that you see are annual rates. And when it comes to promotional rates, they're only good for the length of the promotion. So if you see an advertisement that says we're offering a high interest savings account rate at a promotional rate of 6%, read the fine print, because 6% is the annual rate, but the promotion might only last for 6 months. So if it's only for 6 months, then the rate is actually 3%. And the other thing about high interest savings account is that it fluctuates while the money is in the account. So let's say I were to park $10,000 into a high interest savings account, and when I open it up, the rate that was being offered was 5%. Well, that rate's going to go down or up depending on the fluctuation of the Bank of Canada's rate announcements. And right now we're in an environment where rates are coming down. So whatever it is that you have at a high interest savings account right now, it's going to go down in the next for the next little while until the next big event happens, basically. High interest savings, GICs, not good options for long-term investing. GICs, the only time I would recommend GICs is when you don't want to take any risk. Perhaps it's the first time in your life you've ever had a lump sum of money. You don't need it now, you need it in the future. You know that you don't want to put it in the markets because you're scared because of your habits, your spending habits maybe, and you just want to lock in a rate, then that's fine. High interest savings account, the only time it's a good option is if you just need to park your money for a short period of time. A short period of time could be anywhere up to like about a year, and even a year is a little bit long depending on your situation. One of the comments, I think I just answered it, for short-term savings goals for high interest savings accounts, can we take out the money right after? Yes, you can. So high interest savings accounts, they're not locked in like GICs. So tomorrow, if I walk into the bank again with $10,000, plugged it into opened up a high interest savings account and plugged it in, but then a week later I needed it, you're allowed to take it out. So it's not locked in at all. It's very liquid. Don't forget, these are just types of investments. If there's any return or profit on the money, how you're taxed depends on what envelope it's in. So if you placed your money in a high interest savings account that's non-registered and there's a return, that amount becomes taxable income. So just remember that. If it's within a TFSA, a tax-free savings account, it's non-taxable because it's within a tax-free savings account. So just don't confuse the two. All right, so GICs, high interest savings accounts, and next are bonds. So bonds are technically, if you want to talk about if you want to mention financial jargon, bonds are debt securities, or they're considered fixed incomes. These are terms that you might see, or terminology that you might see when you receive paperwork from your financial advisor or the bank that you're working with. Basically, it's a loan. It's a loan, and it's a loan to a government or to a corporation. And in return, the government that you're lending this money to, or the corporation, agrees or says that they're going to give you back a certain amount of interest. And then once the term is over, they'll give you back the capital. It's important to mention that bonds, generally speaking, are not as risky, but it depends on who you're issuing that loan to. So who am I going to pick on? I'll pick on, I'm going to look in the comments. I'm going to pick on Jenny because I know her and I hope she doesn't take this personally. So let's pretend Jenny is the government, and Jenny is the government, and she needs to raise money. It's a bad time right now, and she needs investors. So she comes to all of us who are watching this webinar and says, I'm issuing government bonds. Jenny, the country, Jenny is issuing government bonds, and I'm looking to give you a 5% annual return. Now, sounds great, but is Jenny reliable as a country and as a bond issuer? So there are some countries and some corporations that issue bonds, but they don't have a great credit rating. So just like people, governments and corporations also have a credit rating, depending on how well they pay back their loans, including the loans that we've lent to them. Canada has a AAA credit rating because when they do issue bonds, they pay them back to their investors. And who are their investors? Us. So we can't say that bonds are guaranteed, but they're pretty low risk considering in the history of Canada, Canada's never missed a bond payment to its investors. Same idea with corporations. Bigger corporations tend to pay back loans to their investors. If you look at other countries in the world, probably a lot of countries offer bonds, and they promise a higher interest rate that's more attractive. The problem is you don't know if, number one, if you're going to be paid that interest in the first place. Number two, if you're going to have your capital back. Bonds are not guaranteed. Just like if you were to loan money to your friend, it's the risk level. What are the chances that you're going to get this money back? So if you're investing in the bond market or in a bond fund that's Canadian based, the likelihood of you getting that return and getting your capital back are really, really high. But because it's low risk, the returns are lower than if you were to lend money or take out a bond fund with a different country that isn't as stable. They might try to attract you with a higher rate, but again, will they pay that rate, and will you get your capital back? So bonds are a type of investment if you are looking for the short term, if you are heading into retirement and you want to make sure that when each year that you're in your retirement years that you have a certain amount of money available to you. You might not want your money in the markets. You want to make sure that every year you receive your 30, 40, 50, $60,000 a year. So as you approach retirement, you might set it up either yourself or with an advisor that a certain amount of money is invested in bond funds or something that's a little bit more secure, anything that's fixed income. So that's basically bonds in a nutshell. They are they're investments or loans that us as investors give to governments and corporations, and in return for lending them money, they'll give us what's called a coupon rate or interest or a return plus they'll return our capital. Next is stocks. So all of us have heard of the stock market. Today in particular, today's an election in the US. Those who follow me on Instagram, I made a post about that. I do have people who are clients and just people in general who contact me and asking how will the US election affect my investments? And the answer is it's just like anything else in any other time. So for those who are panicking a little bit because you have some exposure to the US, whether it's in stocks or through some type of investment fund, we always have to remember that investments are for medium, long, and long-term goals. They're never for the short term, ever, ever, ever. And if you're trying to invest in things like stocks, like directly in the stock market, or in investment funds that are heavy on stocks as an ingredient, if you do make money, it's luck. And if you lose money, it's a bad investment. Because investing is always for medium or long term. It's never for a short-term goal. And if you try to, as many investors try to do, if you try to do it in the short term, then you're just looking, that's where the gambling comes in. And that's where it's hopefully a stroke of luck. What's the minimum you could put in for bonds? It really depends on the financial institution. So some financial institutions will allow you to invest with just $50 a month, but others will have a minimum. So it really depends on where you go and the specific fund that you're investing in. So basically investing in stocks, what you're doing is you're investing in actual shares of companies, of publicly traded companies. So here in Canada, the big stock exchange is the Toronto Stock Exchange. In the US, it's mainly the New York Stock Exchange, and the NASDAQ. So you're literally buying shares or partial ownership in companies that are listed on the stock market. Other terms that are interchangeable with stocks are shares and equity. So you may have heard of terms like I have equity in a company, or I have an equity, a Canadian equity fund, or I have shares in a company, or I own stocks in a company. It all basically means the same thing. You own a piece of the pie. You and millions and millions and millions of other investors. Stocks are volatile. They go, the stock market is open Monday to Friday. So in any given day, any given week, any given month, they fluctuate, they go up and down. What are some of the things that cause stock markets to go up and down? Things like elections, news in the markets, when publicly traded companies do their earnings reports. So basically how well they did over the quarter, that could affect share prices, because some of this information is key to investor confidence. So sometimes we always look at trends, but for me, what I always tell clients is that it boils down to whatever your personal financial situation is. Trends are economic trends, and stock market trends and investor trends are kind of like the weather. So how do meteorologists predict the weather? They predict the weather based on data and based on trends. Is it a 100% science? No, but it's fairly predictable. We know, generally speaking, here in Montreal, it doesn't snow in the summer. We might have a one-off where it snows in May, but generally speaking, in the summer, it doesn't snow. Same thing when it comes to stocks, and same thing when it comes to the history of stocks. But stocks overall are volatile. They go up and down, but there are different types of stocks. A company that has been around for 100 years, definitely there's a track record that you could look at versus a company that was just listed on the stock market. Okay, everybody wants to find the darling. Everybody wants to find the next Amazon or the next Nvidia or the next Facebook. Again, it's a gamble. We never know. Do your research and see if this is a risk that you want to take in your portfolio. But in a nutshell, stocks are basically ownership in companies, you and millions of other people. Next is investment funds. So we went over bonds, we went over stocks. These are the most common types of securities, as they're called. Now we're going to get into investment funds. So investment funds are baskets of different types of investments. And I'm going to focus on mutual funds and segregated funds. So if you've ever invested with a financial advisor or at a bank, then you probably have some type of access or knowledge of mutual funds. Mutual funds are baskets of a combination of stocks and bonds at different degrees. There are literally thousands of different types of mutual funds at different risk levels. You could invest in mutual funds that are basically a bond fund. So it's a basket, like the entire fund is made up of bonds, which makes it less risky than an investment fund or a mutual fund that's mainly made up of US stocks, as an example. Segregated funds are very similar to mutual funds, except that they're offered uniquely by under the life insurance umbrella. So as an example, personally, I have my advisor, I have my license as an independent financial security advisor. So the investment funds that I offer are segregated funds. Many of us have segregated funds or are already invested in segregated funds, but don't even realize it. If you work for an employer and you have a group RRSP or group TFSA, chances are you're already invested in segregated funds because most group benefits fall under the segregated funds umbrella. Mutual funds, not that it's impossible to have mutual funds through your employer's group benefits, but generally speaking, they're under the insurance umbrella. They work very similarly. They're basically a basket of investments, combination of conservative investments like stocks, conservative investments like bonds, as well as stocks at varying risk levels. The type of investment fund, whether it's a mutual fund or a segregated fund, that's kind of middle of the way, is a balanced fund. So balanced funds are usually about half and half conservative, half and half stock market. So if you look at a balanced fund, about half of it is invested in conservative investments like bonds, like T-bills, where you'll get your 1 to maybe 3-ish% as an annual return. And then the other half is invested in the stock market. Now, the stock market could mean many things. It could mean Canada, it could mean the US, it could mean global. So the return on that other half could be anywhere from the 5 to 7%, right up into to the 20%, depending on the volatility of the stocks, like what companies is it invested in, what sectors, and geographically where it's invested in. If you have balanced funds through your employer, those of you who have attended some of my webinars in the past, if you have a group RRSP or a group TFSA and you personally didn't choose your own investments, you probably are invested in some type of balanced funds. And balanced funds in general, their average annual return over time is about 4-ish, 5-ish%. And as a general rule of thumb, again, for those who've attended in the past, if you're investing for retirement and you're not retiring tomorrow, like you have at least 7 to 10 years, It's not the best type of investment. If you're putting money aside for retirement and you have at least 7 to 10-ish years until retirement, your goal should be a 10% return annually on average year over year. And yes, it is possible to achieve that if you're picking the right types of investments. Any questions so far? I didn't see any in the chat. I'm just going to grab some water. Okay. So those are investment funds in a nutshell. Again, varying degrees of risk, varying degrees of return. So next we have exchange traded funds, better known as ETFs. So the first ETF, if I'm not mistaken, was launched in 1990. ETFs were launched to compete with investment funds. So traditionally, if you wanted to invest your money and you weren't buying or investing in individual stocks, if you wanted to invest in mutual funds or segregated funds, you would need to go through an advisor. In 1990, the first ETF was launched, and it was to challenge the whole advisor industry. And basically the idea was, instead of working with an advisor who's taking a fee from you, why don't you invest on your own, just like you would in stocks? So ETFs are available for buying and selling through self-directed platforms, just like stocks. So anybody here who has a self-directed account, either through your bank or through a platform like Wealthsimple or Questrade, you could buy or sell ETFs like you would shares in companies. Now, ETFs, once again, they come in varying degrees of risk. So this idea that I always see online that ETFs are safe are not true, because there are different types of ETFs. You could invest in ETFs that are very similar to an S&P 500 index fund, as an example. So are they safe? Well, they're following the performance of the S&P 500, so it's still volatile. There are also ETFs that focus on specific sectors. Two examples that I always give are here in Canada. There's an investment fund company that has that offers two ETFs. One is a gaming ETF. So the entire portfolio or the entire fund is invested in companies that are related to the video game and the gaming industry. Look, it's a nice idea to invest. Like if you're a gamer, for example, and this is what they were trying to attract, people who are gamers and wanting to invest. Why not invest in something that it's volatile, because the performance of your return is based on how this industry performs. Same thing with the marijuana industry. When marijuana was legalized here in Canada in 2017, investing in marijuana stocks became extremely popular, and there were some investment companies that created ETFs that solely invested in marijuana companies. Now, I don't know if anybody here has invested in them or follows, but the marijuana industry, in terms of a share price and in terms of an investor, has never recovered from 2017. So if you put all your eggs into one basket, as they say, in something that's super volatile, there are people who are still invested in those funds from back in 2017, waiting for the day that they break even. So at least they're not at a loss. So this idea that ETFs are not risky, that's not true at all. It depends what type of ETF you're invested in. And there are thousands of different types of ETFs. So just be careful with that. I have a comment. I'm in a group RSP and don't know what it's invested in, but I chose for it to be aggressive since it's long-term. Not sure that's a good choice. It would be wise to check exactly what you're invested in. So in the investment world, there are kind of like these boxes that we kind of have to check off and make sure that our investments are in those boxes. There's low, medium, high risk. There's terms like aggressive. So I would say, instead of going with what the box says, check to see what type of investment it is specifically, and that would help answer that question if it actually is an aggressive investment. And how you would know that is by getting a copy of the fund fact. Every investment fund has something called a fund fact, which explains all the ingredients, everything that it's made up of. So visually, if you look at a fund fact and most of it is in the stock market, then it is a more aggressive investment fund. If you take a look at it and it's more half and half, like half in the stock market and half in bonds and T-bills, fixed income, that's the term that they're going to use, then it's not an aggressive fund. So it depends specifically. It's a great question though. It depends specifically what you're invested in. All right, ETFs. Next are index funds. Index funds also became popular in the last 10 years, but index funds have been around for a very, very, very long time. All index funds are passive investments that follow the performance of a stock market index. So the most popular stock market index are here in Canada. It's the TSX S&P Composite Index. Sorry, it's really long. Basically, this stock market index follows the performance of the Toronto Stock Exchange. So if the Toronto Stock Exchange does well, then this fund, if you're invested in this type of index fund, yours does well. If they're having a bad day, then the performance of your index fund that you're invested in it also goes down. In the US, there is the Dow Jones, there's the S&P 500, there's the NASDAQ, which are the bigger indices in the US. Again, same idea. They follow a segment of the stock market. If those companies in that index are doing well, so do your investments. If they don't do well, if it's a bad day, or if the market's reacting to, again, tonight it's the US election, then your investment will go down. I keep seeing that ETFs, index funds, are the best. They're not good, they're not bad, they're fine as investments. It's very important to not get too emotional about your investments. They are what they are. Index funds are great, they're really passive, but you'll never outperform the index. So here in Canada, we're very conservative when it comes to our economy, when it comes to growth, when it comes to capital, unlike the US, which is more capitalist. They want to grow, they want to be the first, they want to be the biggest. Here in Canada, we're a lot safer. That's why when markets crash, our economy and our stock market doesn't crash like in the US, because we're a lot more safe. We have things in place to not have much movement. So, which is great on one hand, but as an investor, if you're invested in a Canadian index fund, you're only going to see growth of about 7.5% year over year. You're not going to see more than that. Again, not the worst, but that's what you would expect. Same thing in the US. If you're invested in index funds, you'll never make more money than what the index is making, because index funds literally mimic an index, whatever index it is that you're invested in. Not good, not bad. It's just what it is. They're fine, but it will never outperform an index. The last investment vehicle I wanted to show you, which I forgot to put on the ticker, are alternative investments. So when I meet with clients, I always ask them on the scale from 1 to 10, on a scale from 1 to 5, when do you need your money? Do you need your money like yesterday, like when it comes to investing? Do you need your money much later on down the line, like in 7 to 10 years? Are you not sure? So on a scale from 1 to 5, long-term investing is more in the 4 to 5 range. Short-term investing is in the 1. Like I need to park it somewhere. I don't want to lose any money. So it's more in the 1. And the 3 are like your balanced funds, kind of middle of the way investing, a little bit of both worlds, not too much risk, but you're making some type of money. Outside of the 1 to 5, which is basically most investment funds, there's the 6, which is a little bit outside of the box. And those are alternative investments. Alternative investments are very volatile. And compliance-wise, as an advisor, technically, our clients should not have more than 10% of their portfolio invested in the alternative space. So what are alternative investments? Some of you may have heard of Bitcoin, cryptocurrency. That's considered a volatile alternative investment. I know it's popular. I know it's trendy. When Bitcoin does well or when cryptocurrency does well, all the Bitcoiners come out and they say, this is the best thing since sliced bread. When they don't do well, you hear crickets. I know a lot of advisors are against cryptocurrency. I'm neither for or against. I'm more about the education, but it is a volatile investment. 100% of your portfolio definitely shouldn't be in something like cryptocurrency, not because it's cryptocurrency, but because it's an alternative investment and it's extremely volatile. So you just have to be careful, and there's a lot of marketing push behind it. Alternative investments should not be more than 10% of your entire portfolio. What's your entire portfolio? All the savings that you have. And it also depends on other factors such as your income and your debt level. So you have to be very careful. Other types of alternative investments are actual alternative investments in the exempt market space. So I actually at a point wanted to offer exempt market products or investments as part of my portfolio. I decided against it because that's not the clientele that I serve. Those who are invested in exempt markets need to work with someone who has that license. And what you're doing is there are all different types of investments in the exempt market space. Again, following basically the 10% rule. You're not supposed to be investing more than 10% of your entire portfolio in them. There are things like private REITs that are available. One of the major companies that you might have seen advertisements on Facebook are Equiton or Avenue Living. They're very popular here in Canada. There are other types of investments as well. I know that one of the companies that I work well with is called it's slipping me, but basically they offer an investment fund that buys dental clinics in rural areas. So it's very specific. They're alternative. They're for people who have extra money. They have the equity, they have the net worth, and they're looking for other ways to invest their money outside of the most common spaces. Again, I'll go back to the 10% rule. You shouldn't be investing. Nobody should be investing more than 10% of their entire portfolio in the alternative space. Why? Because there's so much volatility. There's a lot of volatility in it. So you have to invest in it with the expectation of getting a return, but realizing that you might not get the return that you want, and you might not even get your capital. Any questions up until now? All right. Okay. So, oops. Okay, perfect. So we're going to wrap up soon. Call to action. I'm going to end all of our investing basic sessions with pretty much similar calls to action. Sometimes we need to hear this a few times before it actually sinks in. So number one, make an inventory of all your current savings or investments. So somebody had mentioned earlier in the chat that they have a group RRSP that they believe is aggressive. Make an inventory of your current savings or investments, right? Group RRSP with Canada Life. And this is the type of investment you have. This is how much you have. This is how much you're contributing. Make an inventory. That's how we start our investment reviews. Next, start backwards. So when I work with clients on their investments, I ask them to gather all their investments, and now let's start backwards. Everybody has that goal to retire at some point. I use age 65 because that's where a lot of programs are unlocked, like QPP, even though you could get it at 60. That's when you could start shifting your RRSP, you start having access to it. So I start backwards from retirement. If nothing changes, if these are all your investments, this is how they're performing, this is how much you're contributing, how much are we looking at retirement? How much are you expected to have as retirement income during the 35 years of your retirement? When I do retirement planning, retirement lasts from age 65 to 100. These are all projections. So I work backwards from retirement. If nothing changes, you, Jen, as an example, you're expected to have between your group RRSP, maybe you have a pension plan at work, you have private RRSPs, you have TFSAs, with what you're expected to receive from the Quebec pension plan, you're looking to have, $50,000 a year. Now, if we look at $50,000 a year, how does that compare to what you're living off of right now? And then we look at the whole picture. There are softwares that calculate this, but I'd rather have the conversation. And the problem with computers and softwares and algorithms and AI is that you can't have that conversation with them. So there are certain things that these calculators will never calculate for you. Someone mentioned of covered call ETFs where, I'm trying to read this. I've heard of covered call ETFs where some have a dividend return of up to 15 or 20%. Would these be good to add for a diversified portfolio? It depends, because covered calls are anything that has to do with calls or options are a little bit more aggressive and sophisticated as investments. Depends on your entire portfolio. Again, 15 to 20% dividend returns. Companies do offer them. But there's a bit of volatility and depends what type of companies there are. As an example, here in Canada, none of our banks, the major banks, they always make their dividend payments. And I think their dividend payments are 5-7%. So they're really not that bad. When you have companies that say that they're going to issue up to 15-20%, what are they? A lot of times they're in the tech sector. So you just have to be careful. You want to make sure, again, you're allowed to take risk, but what's the worst case scenario? So is it a good idea? It really depends on your risk level and everything else that you have. You want to make sure that you have your bases covered first before you start diving into that. So call to action number 2, start backwards. Start with retirement. Make sure that you have money and investment set up so that you could retire comfortably. And this doesn't start when you're 55 years old. This is supposed to start much earlier than that. And lastly, review the performance of your investments and how they align with your goals. Investing is a journey. It's long term. Just like diet and exercise, you don't do it for 3 months and that's it. It's if you want to live long, hopefully, and stay healthy, it's a lifelong decision. And it's the same idea with investments. I actually met someone for lunch today, and she told me that for the first time ever, she realized what I told her. I explained to her that instead of putting money aside for that vacation, why don't you put money aside and invest it, sacrifice for a couple of years, wait for your investments to grow, and start going on vacation with the return on your investments. And so now she's in that position where she's made money in the markets and her investments have done well. And she's like, wow, I could actually withdraw $5,000 from my TFSA because that's part of my investment return. So it's not really money that I put aside. It's my money working for me. And what's funny with that is that when you start seeing the returns over time, you think twice about spending it. It's easier to spend money that you've put aside, like that you've squirreled away, versus when you've squirreled away money for years and you start seeing the growth on your investments. So that's something I try to teach with clients, like sacrificing for a bit, put the money inside, invest it. And instead of using the money that you've worked so hard for to pay for things, let your money work for you and start paying for things with the growth on your investments. I have a client who's making a withdrawal right now. She wasn't sure if she was going to pay off her debts with her savings, or if she was going to invest. She chose to invest, and now she's withdrawing the growth of her investments to pay off her debts. It wasn't a huge amount, but she was really happy. She was really happy that she was in a position to do that. So after today, it's important those three steps: make an inventory of your current investments and savings. Start backwards from retirement. Ask yourself, how does my retirement look, and how do all the other pieces fall into place between now and then? and review the performance of your investments and how they align with your goals. Next week, the topic is going to be common financial jargon simplified. Right after this session, you're going to receive a copy of the recording by email, and then it's going to be followed up with the link to register for next week's session. I touched a bit on time horizon as well as risk tolerance today. I'm also going to get into things like asset allocation, simple and compound interest, how they work, inflation, recession, and some of the common financial terms not necessarily related to investing, but that are important to know. If anybody here has any questions about their investments, if you want to meet for a review, my contact information is going to be in the follow-up email. I'm always available. There's no charge. We could just sit there and kind of look over everything. It usually takes about 45 minutes or so. I'll explain how I work as an advisor. My goal is, yes, this is what I do for a living, but my goal is to make sure that any woman who's around me, because the majority of my clientele are women, is to make sure that all of us aren't stuck in GICs and high interest savings accounts for the rest of our lives. That is not how we're going to grow our wealth. We grow our wealth through investing. And that's the definition of having our money grow for us. I know that not everybody here is going to be a client of mine, and that's fine. I will still continue to give this information out because it's important to know. But know that I'm always available if ever you want to sit down and review your investments without any judgments. Trust me, I've heard it all. But if you don't want to work with me, or if you already have an advisor, I know it's not always easy. It's money, so sometimes it's tricky. But I'm always available if you have any questions. If you have any specific concerns about your situation, maybe you're not from Canada, maybe you're thinking of leaving Canada. If you're American, if you have dual citizenship, or if you have investments in the U.S. trying to bring them to Canada, I actually have a whole team that helps take care of that. We have a tax specialist who specialize in U.S. Canada taxes, whether it's for business or personal. So please feel free to reach out. If you are a real estate investor, if you have a lot of assets, if you're wondering if you have a couple of businesses, wondering if it's the right time to create family trusts, please reach out. This is where a lot of misinformation comes out. I see a lot of people setting up family trusts when they really don't need to. They're quite expensive to set up. They're quite expensive to maintain, and fiscally, financially, it doesn't make sense. Don't start spending money just because you read it somewhere online. Same thing when it comes to businesses. Just know that I'm here if you have any questions. Whatever you do, like I always say, always work to be financially better off a year from now than today. That's what we're trying to do, grow our wealth and make sure we're financially better year over year. If you have any questions, my email address is there. Please feel free to reach out, and hopefully I get to see you all next week. So take care, have a great night, and please reach out if you have any questions.